Among the many challenges that we try to solve in investing is the question of predictability of our passive incomes. We are used to monthly salaries, monthly wages, constant streams of incomes from our businesses or side hustles, and naturally, our expenses are structured in a way that they should be solved on a monthly basis. And therefore, the question of predictability becomes very pertinent together with the amount of passive incomes to sustain us and make the investments sustainable so that we don't eat down the principal investments, which is the capital, which will equate to cutting down the tree that is giving us the fruits. After 3 seconds break, we are looking at a process of planning our investment in fixed income securities such that they guarantee us a constant stream of passive monthly income for life. Don't go away. Welcome back. We are looking at solving two key problems with fixed income securities. And one is predictability. Being certain or sure of when you are going to receive that passive income. Being objective in planning, because we need to attach a goal or a purpose to the expected income. And number two, we are solving a problem of interest rate risk. When interest rates change, when inflation change, it affects interest rates. And we lock ourselves into a very long-term bond or fixed security, it may lock our capital in an instrument that whose return does not reflect the market. And therefore, the solution that we tailor for this, we call it laddering, where laddering has sometimes been referred to as layering. And in this case, laddering is a combination or combining different fixed income instruments in order for us to acquire the monthly passive consistent income. In the case of a bond ladder will combine different bonds that mature or that have different maturity periods or different horizons and possibly different rates. However, the rates must be within our target rates. You don't go investing into just whatever rate that is given in the market. We are investing at our target rate. We know what we are going to get in the market. And it is this rate that will be subjected to the object of our face value, the amounts that we have invested to determine our expected income, which we have already solved the problem of predictability having invested in a fixed instrument, because the nature of this instrument is that they guarantee a return on regular periods. In this case of a bond pays 2 times in a year or biannually after every 6 months. And it also guarantees a recoupment of that investment or a redemption on a specific date, meaning that we can plan knowing when all these amounts will be received, and purposely we also plan where to take the money. To ladder bonds, we take cognizance of that fact that they pay biannually, 2 times in a year. So we identify the specific months, 2 months, that a particular bond will pay out its coupons. Then we purchase several bonds. In this case, there will be 6 bonds in order to cover our 12 months in 1 year, where each bond will cover 2 months. So if you have a bond that is paying in January and July, we'll look for another one paying in February and August, another one that will pay us in March and September, another one to pay us in April and October, another one to pay us in May and November, and the last one should pay us in June and December. Those 6 bonds will have covered a whole year, but they are maturing in different periods, or they have different maturity periods. One could be maturing in 1 year, another one 2 years, 3 years, 4 years, 5 years and 6 years, or 5 years, 6 years, 7 years. We plan the placement of the bonds in such a way that once the first bond mature, that is the shortest bond, we will able to reinvest it in a longer period than our last bond, so that we never run out of income. How do we cure the problem of interest rate risk? If we tie our capital in very long-term bonds, the changes in interest rates, which will translate into changes in inflation, will affect the prices of these bonds. An increase in rate decreases the price of our bond in case we wanted to sell, or we are in the business of reselling our bonds. Therefore, what we do is that we are investing in medium-term bonds, short to medium-term bonds, so that we are within the period that we can be, the factors that can affect the market are a little bit predictable or somehow certain, so that when our investment mature, we are reinvesting it, covering that shortage. And in this case, we shall be offloading bonds at our current rates, reinvesting in the new interest rates. In this case, we are looking at maximizing our income out of our bond investment. The newer bonds that come with higher interest rates, which reflect the changes in the current inflation rates, will cushion our incomes against loss of their purchasing power. Where do we source these bonds? There are 2 key places or 2 key sources of our bonds. One is the primary market, and this market is characterized by you, the investor, either you in person or through your elected agent. You are purchasing the instrument directly from the issuer, that is the central bank, either as a reopened sale or a reopened bond or a new issue. And the second option is purchasing the bond from the secondary market. Once auction in the primary market is over or closed, all those instruments are offloaded or pushed to the secondary market, that is the stock exchange, for purposes of trading. And therefore, for the bonds that we did not get available in the primary market, we can get them and buy them from the exchange market or the secondary market through the use of our brokers. That way, you'll be able to ladder 6 bonds to cover 12 months in a year, characterizing a constant monthly passive income. One man said, the sweetest form of income is passive income. Lastly but not the least, in the process of laddering and to balance our investment, we could have necessarily other portfolios sitting in equities. And equities pay in two ways. When around interim dividends, final dividends, where the two are merely dividends but paid out at different times. Then we have the capital gains in case we offload those equities. But such incomes, we will utilize them in their lump sums towards reinvestment or taking care of our other scheduled goals. But for purposes of our monthly consumption, in passive income will depend on the laddered passive regular income from our bond ladder. Thank you for watching.